U.S. Natgas futures surged over 6%, breaking above $3.90 on Friday, as forecasts pointed to colder weather and heightened heating demand over the next 2 weeks. Meteorologists anticipate below-average temperatures across much of the country through January 25, with the most frigid days still ahead. LNG exports also reached record highs, with feed gas flows hitting 15.5 billion cubic feet per day, driven in part by increased activity at the new Plaquemines LNG facility in Texas. On the supply side, production appeared to stabilize as freeze-offs common during extreme cold began to subside. For the week, natural gas prices posted a robust recovery, climbing over 17% following a period of recent declines. Nevertheless, despite the current price surge, it appears speculative to me. Looking at the heating degree days forecast, the deviation from the January average of 32 HDDs is about 3 days, roughly a 9% increase. However, the current price of $3.90 is more than 20% higher than the average price spikes typically seen during this time of year, even when HDDs exceeded 40 days. This suggests that natural gas is significantly overvalued relative to the underlying fundamentals, with a more reasonable price being no higher than $3.20. As is often the case in commodity markets, high prices tend to sow the seeds of their own decline, as they incentivize increased production and dampen demand. In the case of natural gas, production is likely to ramp up soon in response to the recent price surge, as producers take advantage of favorable market conditions. Additionally, political changes could play a significant role in shaping the supply landscape. With elected President Trump expected to eliminate or significantly roll back the drilling permit restrictions imposed under the Biden administration, we may see a substantial boost in domestic drilling activity. This would flood the market with additional supply, exerting downward pressure on prices. Given these factors, a price correction below $3 seems increasingly likely on the horizon, as the market adjusts to both rising production levels and a shift in regulatory policies. Nevertheless, the majority of market analysts anticipate a price recovery above $3 by year-end, driven primarily by the expansion of LNG export capacity. With new LNG facilities coming online and existing terminals operating near full capacity, the demand for U.S. natural gas in international markets is expected to surge. This growing export potential is likely to offset domestic supply increases, providing a solid foundation for price support. The outlook for nat gas prices remains uncertain, driven by strong demand fueled by ongoing cold weather. This could sustain the current upward momentum, with a breakout above $4 potentially paving the way for prices to test the $4.20 level. However, any unexpected shift toward milder weather could trigger a pullback, with traders eyeing key support levels at $3.75 and within the $3.40 to $3.20 range. For now, weather-driven demand continues to dominate market dynamics, keeping sentiment firmly tied to short-term temperature forecasts. Please like, subscribe, and comment to support the channel. See you in the next one.